If you'd like a free revision checklist that covers all the topics on your course, then do go to the description box and you'll see the link there. Don't forget to subscribe so you're notified when more videos like this are released. A budget is a spending plan for the future that outlines revenues and costs. By having a budget, it allows the business to plan. This is because they can anticipate areas in which they may be overspending and are able to fix the problem before it arises. In addition to this, it may be motivating to managers due to the fact that they are in control of their budget, which gives managers responsibility as well as allowing them flexibility on where money is spent. It's very important for you to know the purpose of budgeting. Now, budgeting establishes spending limits. Budgets set clear limits on how much can be spent in various departments or purchase expenses, such as marketing and wages. Budgeting allows managers to think ahead as it plans for the future. Budgets can help motivate staff in a department. It provides staff with targets and standards. Fear of failing to reach budgeted targets can incentivize staff to work harder. Budgeting gives financial control to lower levels of management who are best able to make decisions at their level within the business. There are two types of budget that we will look at: historical figures or historical budgeting and zero-based budgeting. Historical figures. This is where the business uses previous data as a guide and then makes minor adjustments based on known changes in circumstances for the department. For example, there may be an increase in inflation or a change in raw materials, so they would make minor adjustments to the budget. Another example of historical figures is where a business is anticipating a 15% increase in revenue, and they may decide to add 15% on wages, advertising and purchasing budgets. This kind of budgeting is fast and straightforward and generally makes assumptions that the business conditions stay unchanged each year. This is not always the case though. Zero-based budgeting means starting from scratch. It means starting the budget from zero each year with the expectation that the person managing the budget is able to justify a budget figure that they can work with for the coming year. This type of budget can be very time consuming, but can ensure that there is less wastage, unlike with a historical budget where the budgets may just increase year on year. Some businesses may decide to use a zero-based budgeting every few years, or even before they introduce historical budgeting. The process used for monitoring budgets is known as variance analysis. A variance occurs when an actual figure for sales or expenditure differs from the budgeted figure. It is important to note that variances are referred to as favourable or adverse. Favourable variance is where the actual figure was better for the business than the budgeted figure. The actual figure is actually how much was spent or how much money came in, and the budgeted figure is the planned amount. So for example, budgeted sales revenue is higher than the actual sales revenue, then there's a favourable variance. If the actual wages were lower than the budgeted wages, the amount of wages that they planned for it to be, then there will be a favourable variance. If the business spent less on fuel than the budgeted figure, what they planned to, then there will be a favourable variance. An adverse variance is where the actual figure was worse than the budgeted figure, so it's worse than the planned amount. For example, if the actual sales revenue is lower than the budgeted amount, so they expected to have a certain amount in sales revenue and it was lower than that amount. The actual cost of the raw materials was higher than the planned budgeted cost, and utility bills are higher than the budgeted planned amount, then there would be an adverse variance. Let's take a look at how to calculate the variance. So we have the revenue and cost column. So we can see there we've got sales of A, sales of B, and we have raw materials and labour costs. So the sales of A and sales of B is the revenue, and the costs are the raw materials and the labour costs. Then we have the column where we've got the budget. So the budget column is the amount that the business plan on receiving as revenue or paying as a cost. Then we have the actual column, and that's the amount that actually happened, how much was actually spent or how much actually came into the business. Then we need to calculate the variance, which is the difference between the budgeted amount and the actual amount. And then you should also identify whether it's favourable or adverse. So some straightforward calculations here. So we've got sales of A, the budgeted amount was £150 and the actual amount was £160. So that gives us a variance, the difference, of £10. And that makes it a favourable variance. Then we have sales of B. Budgeted amount was £90, the actual amount was £20. And that gives us a variance of £70, which means it's adverse, because we had a budget of £90, but we actually only sold £20 worth. So therefore there's a variance of 70. Now the raw materials, this is a cost to the business. The budgeted amount that the business thought they would spend on raw materials was £45, and they actually spent £75. So therefore there's a variance of £30. And that means it's adverse. Labour costs, budgeted amount for labour costs was £25 for this given period. The actual amount was £30, so the variance is £5, which means it is adverse as the actual costs were higher than the budgeted amount. As you can see, the process of calculating a variance is simple. It simply involves a comparison between the budgeted figure and the actual figure. Variance analysis can be carried out each month and will show before the end of the financial year that the firm's finances are not as planned. This allows the business to take action to reduce expenditure or increase revenue at an early stage. Budgeting for a business is a crucial financial planning process, but it can be accompanied by various difficulties and challenges. Some of the common difficulties of budgeting includes uncertainty and inaccuracies. Predicting future revenues and expenses can be challenging, especially for startups or businesses in rapidly changing markets. External factors like economic conditions, market trends, and unforeseen events can lead to inaccuracies in budget projections. Complexity. As businesses grow or operate in multiple segments or locations, budgeting becomes more complex. Coordinating budgets over various departments, projects, or subsidiaries can be quite difficult. There may be resistance to change. Employees and management may resist budgeting changes that affect their department or responsibilities. This resistance can hinder the budgeting process. Preparing, reviewing, and revising budgets can be time-consuming, and it can divert attention from other crucial critical business activities. Thank you for watching this video. The next two videos that will appear on the screen are what YouTube thinks you should watch next.